Good morning and welcome to Storm Stock Solutions. I'm Grant Mercer. With the opening bell just ahead, let's bring some clarity to the chaos in today's markets. The big pre-market story is the Federal Reserve and the labor market. According to reporting from MarketWatch, Fed Governor Christopher Waller made it very clear that the next jobs report, not the Supreme Court's tariff ruling, will be the key driver for whether the Fed even considers a March rate cut. So for traders, the game plan into early March is simple. Jobs data is the North Star. Until we see that report, rate cut expectations are likely to shuffle around the edges, but not fully break either way. Layered on top of that, you've got tariff politics heating up in Washington. Another MarketWatch piece highlights that Congress has less than 150 days to turn President Trump's tariff agenda into law or risk what's being called a revenue cliff for the federal budget. That puts trade back on the front burner for markets. Tariffs affect corporate margins, supply chains, and ultimately growth. It's not today's trade war panic, but it is a slow burn macro story that can influence sector rotations, especially in industrials and exporters. You can already see some of that tension showing up in commodities. MarketWatch notes that gold is pushing above the $500 mark, and silver is powering higher as tariff jitters creep in. When you see precious metals bid like this, it usually tells you a couple things. Number one, investors are looking for insurance against policy uncertainty and potential inflation. Number two, there's at least a modest risk-off tone under the surface, even if the indices look calm at the open. That metals move, combined with Waller's focus on the jobs report, gives today's backdrop a cautious, macro-sensitive feel. On the sentiment side, there's also a lot of chatter about the AI trade and big tech leadership. MarketWatch is highlighting a piece describing how the once magnificent 7 has morphed into what they're calling the lag 7. Big tech and AI hyperscalers seeing enough weakness to start visibly dragging on the S&P 500. That's an important shift. For the last couple of years, those mega caps have been the engine under the hood. If they're losing steam, traders will be asking, is this just a healthy rotation or the early stages of a broader derating? Feeding into that nervousness, another MarketWatch article is making the rounds about an AI doom scenario from Citrini Research, outlining a case where a booming AI economy still ends with the S&P 500 diving nearly 40%. Now that's one scenario, not a base case, but it reinforces how split the market is on AI. Some see a structural growth story, others see concentration risk and bubbles. For intraday traders, that means AI headlines can spark exaggerated moves, both up and down, in the usual chip names, hyperscalers, and AI-adjacent software. Now, even though we don't have a clear list of classic pre-market winners today, there are still pockets of strength and opportunity that professionals are watching. In healthcare, Gilead is in focus with a $7.8 billion buyout of its partner, Arcellx, whose stock is heading toward a record on the deal, according to MarketWatch reporting. That's a reminder that even in a choppy macro tape, M&A can create its own micro bull markets. For the biotech space, deals like this often spark speculation about who might be next and can put a valuation floor under certain subsectors. Again, not a call to chase anything, but a sign that strategic buyers see long-term value in select therapies and platforms. On the flip side, let's talk about areas to handle with care. At the index level, that lag 7 story tells you big tech is the primary risk pocket right now. When your former leaders roll over, it can create an outsized drag on cap-weighted indices, even if the average stock is holding up. Traders will be watching whether selling pressure remains concentrated in the mega-cap names or broadens out. If you start to see weakness spill into second-tier growth in cyclical names, that's when a garden variety rotation can morph into a more serious correction. Another fragile area today is transportation, specifically airlines. MarketWatch is reporting that a major northeast snowstorm has already led to more than 5,300 flight cancellations, and airline stocks are taking a hit before the open. Weather is temporary, but it can amplify existing concerns about demand, costs, and capacity. Short term, that's a headline risk group. Expect elevated volatility as cancellation numbers update, and as the market assesses how much of this is a one-off versus a drag on quarterly guidance. Let's move to some under-the-radar setups, not recommendations, just names and themes I'm watching in the background. First, the big box home improvement duel, Lowe's versus Home Depot. As highlighted by MarketWatch, Lowe's stock has outpaced Home Depot's, and both companies report earnings this week. That's a subtle but important read on the U.S. consumer and housing-adjacent demand. Professionals will be listening closely for commentary on DIY versus pro spending, big-ticket discretionary items, and any signals on remodeling trends. If one of these names surprises on the upside or downside, it can ripple through retail, housing, and even certain industrial suppliers. Second, that Honeywell story. According to Steve Goldstein's reporting, Honeywell just secured roughly a 26% discount, about $600 million off, on a chemicals-related acquisition tied to a struggling part of the industry. When a high-quality industrial player is able to bargain hunt like that, it tells you the target sector is under stress, but it also says strategic buyers are willing to step in at the right price. That kind of deal can be an early sign we're somewhere in the later innings of pain for certain chemicals and sustainability-linked businesses, even if the day-to-day charts still look rough. And circling back to the airlines and the snowstorm, while they're clearly under pressure today, weather-driven sell-offs sometimes get reevaluated once the storm clears and the market tallies the real impact versus the headline fear. That doesn't mean jump in, but it does make airlines and related travel names a good case study this week in how quickly sentiment can swing on transient shocks. So, to set you up for the opening bell, watch how futures respond to every fresh comment on rates and jobs. Waller's emphasis on the coming employment report is your macro roadmap. Keep an eye on gold and silver as a real-time gauge of tariff and policy nerves. And pay attention to whether big tech weakness stays contained to the lag 7 or starts to drag the broader tape lower. I'll be back with intraday updates once the market gets moving to cut through the noise and see what really matters. Remember, this is information and education, not personalized financial advice. As always, I'll be here to keep clarity through the chaos of these markets. On behalf of Storm Stock Solutions, I'm Grant Mercer.